can't keep a good market down, or can you? Well, yesterday, of course, we had a blistering shakeout after the very eye-catching CPI number out of the U.S. Everybody suddenly got concerned that even fewer rate cuts are coming, and stocks swooned, dollar went up, and today things settled some. Stocks came back. A lot of the way dollar idled, though it didn't crack any key levels, weakened a little bit in spots. And it is as though everything is digested and we are moving on. But maybe not so fast. Welcome, this is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to take a look at what comes next here. Because if we thought we were out of the woods, well, we're not. Today was a perfect day for the markets to digest a little bit because the calendar was largely devoid of any reasons for them not to lick their wounds after yesterday's bloodbath. But tomorrow the calendar fills back out. And we are going to have a look here, not even just at tomorrow, but really get a little bit thematic and focus on what happens tomorrow and Friday here, because there is a theme to connect them, and that is the U.S. consumer. Everything from here hinges on that U.S. consumer. Now, of course, U.S. economic growth always hinges on the consumer. Household consumption is close to 80% of GDP growth. But now, this market's ability to hold up probably hinges on whether the consumer is still feeling chipper in an environment where rate cuts are looking fewer and inflation is looking stickier. So what we're going to look at here first is a bit of stage setting, understand where we are in the process, and from there, see if we can't figure out what comes next as this key data crosses the wires. So first and foremost, here's where we are on stocks relative to policy expectations. And we can see that what we're looking at here since the beginning of the year, essentially, is a market telling us that stocks are okay with not getting all of the aggressive easing that markets were hoping for as 2023 came to a close. So here is the blistering rally in the fourth quarter of last year. It begins about late October, early November, and coincides, as you might expect, with increasing Fed rate cut-ons. As the calendar year turns, we ultimately settle at about, give or take, 6 cuts, 150 basis points. That's 1.5%. Considering a standard size cut is 25 basis points or 0.25%, that gives us 6 cuts right here. And you can see as this starts to steady, so too stocks steady. While it's building, stocks are rallying. What we see at the start of this year is something pointedly different. And by the way, this worked last year as well in the other direction when we saw fewer rate cuts. This, of course, the spread between Fed funds futures that gives us the cumulative difference between implied Fed funds rates at the start of the year and the end. And we can see that as there were fewer cuts implied, so these numbers get less negative, and we go from about 6 down to where, incidentally, we are currently, which is about 75 basis points, stocks go down. When it builds back up, stocks go up. This now is something very different, because what we're watching is rate cuts diminishing, stocks going higher. And so the question then becomes, well, is it that the markets have become acclimated to the idea that we don't need as many cuts, and so now stocks can continue to build against a positive backstory? And by the way, there is good fundamental reason for that backstory. Consider that as we look at the way U.S. economic data has performed relative to expectations, this is, of course, an index from Citigroup, we have U.S. economic data getting worse from mid-2023 into the end relative to forecasts, not necessarily undershooting those forecasts, but losing its ability to beat forecasts, and so becoming progressively soggier over about a 6-month run. And of course, as that sends the message that the economy might be weakening, we start to want more rate cuts. And as those rate cuts then build, you get stocks saying, oh, good. There's going to be rate cuts. The economy is deteriorating. We're going to need those cuts. Yes, this is good news. And so you can see here, again, here's where that data is deteriorating from about here to here. And as it's deteriorating, when the rate cuts seem less ample, stocks don't like it. When they seem more ample, they do. Well, what we see at the start of this year is different, perhaps because this is different. The data is getting better. And so the markets are looking at this and saying, okay, well, if the data is getting better, then we need fewer cuts for good reasons. The economy is stronger. We don't have to be bailed out to this 6-cut level of extent. We can just have 3, let's say, or 4, and that's okay. So the dynamics are fundamentally different here. Where they remain very much consistent is for the US dollar. In the green line here is the dollar's average value against its top 4 major counterparts: euro, pound, yen, and Australian dollar. And what we see here is fewer cuts, stronger dollar, because of course its yield differentials then move in its favor against other currencies. This is the classic way that currency markets work. When a currency's yield differential position improves, that is, it is seen as having higher rates than its counterparts, then that currency becomes more attractive because currencies are yield-bearing instruments, much the same as stocks are. Stocks, after all, don't just move up and down in price. They also tend to pay a yield, dividend yield. Well, so do currencies. It's not a dividend yield, but it is an interest rate. And so as we get the decline in rate cuts expected by the markets, you get a stronger dollar. As you get more rate cuts in the outlook, the dollar gets weaker. Now, as you get fewer of them, it gets stronger. So this is about as textbook as it gets. And we can see the pointed shift here. The small dots are the last FOMC meeting in January. The big dots are the preceding FOMC meeting in December. You can see they're pointed much more steeply lower. Rates at the end of the year here expected to finish near 4%. Now consider what that suggests. Here we are at 5.3. Coming down to 4 is at least 5 cuts. So what we're looking at there is at least 125 basis points in easing, veering on 150, maybe. About halfway there. Now the situation is quite different. We've moved significantly up in the curve here. And you can see by the time we initially are seeing the first cut, we're probably somewhere in June, July. By June, you can see we're off 20 basis points, 5.33 here for the midline rate. Fed, of course, sets policy in ranges. So here we're looking at the median of the range, 5.25 to 5.5 is 5.33. So this is the median effective policy rate. By June, you can see we're down 20 basis points off that. So almost a full 25 basis point cut. It's really official here by July. And then from there, it looks like we come down between 75 and 100 basis points. So anywhere between 3 to 4 cuts. Much, much less dovish than what we saw here. And ostensibly, it is because that U.S. economic data story has meaningfully improved. Better NFP than expected, better GDP than expected, better PMIs than expected, better job openings than expected. And of course, now hotter CPI than expected, which would make sense. If you have an economy that's posting better jobs growth, better overall economic growth, more job openings than expected, it is an economy that's understandably running hotter. That hotter economy is going to give you more of a pressure upward on inflation. So it only makes sense what's going on here. But of course, the question now is, what comes next? Because that hotter economy and that hotter inflation is a burden on consumers. And we know consumers are already burdened because we're not in deflationary mode. Prices aren't falling. They're just rising by a much slower rate than they were, call it, a year ago or 2 years ago. So inflation, without question, has come down dramatically. In fact, if we look at where we were versus where we are, consider the peak in the consumer price index back in the middle of 2022 overall, including the things that the Fed typically factors out, energy and food, that peak was at 9.1%. We are now down to 3.1%. So basically, 2/3 of the inflation rate are gone. But prices are still growing at 3.1%. They're not shrinking. So more inflation or stickier inflation is, of course, a burden on consumers. And consumers are the way this economy grows. So naturally, the question becomes, well, yeah, this is all well and good, but how are the consumers going to shoulder this, and what does that mean going forward? Well, we're going to find out. The first piece of news coming to us tomorrow is going to be retail sales. And the expectation here is that we are going to come down. The month-on-month number is the one we typically look at here. It's expected to come in 0.1%. Now, it's not terribly surprising that January's number would be a little bit softer. There's typically a little bit of a downswing, even just seasonally, because what we're looking at here is something of a cool off after a holiday shopping season. Typically, this year was a little bit soggier of a shopping season than is the historic norm. But even so, what we're looking at here, if we look at the year-on-year direction, is a pickup. The loose forecast here, 5.8% year-on-year, up from 5.6% year-on-year, which would incidentally be the strongest that we've seen since January of last year, when the year-on-year retail sales number was 7.4%. As a matter of fact, retail sales have been steadily climbing trend-wise since about April of last year. So what we're looking at here is an interesting sort of setup because the expectation is of a soggy number to some extent, but one that isn't out of context, one that isn't out of trend, one that generally falls within the kind of down 0.2%, up 0.8% range that we've established, essentially going back to, you guessed it, April of last year. So as the overall trend has been moving up here, this has been a kind of normal month-on-month oscillation. And this would be very much within that norm. Now, of course, we've just said that U.S. economic data has been tending to beat forecasts. In fact, this was largely why we anticipated that CPI was going to be stronger than expected before it came out, and why we thought that the dollar was going to get another big leg higher on that data as Fed rate cut expectations pulled back, which is, of course, exactly what's occurred. So it may very well be that this number is better than expected. And if it is, you could very well see the market react with some concern. As we saw, of course, earlier in the week, when that hot CPI number came out, stocks swooned. Now, they haven't broken the trend higher here. That continues to be there, but they certainly didn't like the move to 75 basis points in cuts versus 100. And they've since kind of shaken it off a little bit. And of course, rate cut odds have moved closer to the mid 80s for the full year. So essentially somewhere in the middle of 75 and 100, not quite as bad as it was yesterday for stocks. But if this number is indeed better than expected, it may very well be that we get back to 75, or even perhaps something even more modest. These bars continue to get shallower, and then we get another day of stocks falling out of bed, and perhaps still a stronger dollar, since that's the one that seems to follow this much more consistently than stocks have been since the beginning of the year. Then on Friday, we get what has been one of the most consistent foreshadowing tools for where the consumer lives and how the consumer thinks. This is the University of Michigan Consumer Confidence Survey. And we can see that since about the middle of 2022, really as the Fed started raising rates, the Fed, of course, began in March of 2022, and some of the initial adjustment in that direction was already underway by around mid-year. Well, take a look. The gray bars in the back here are in 1-year inflation expectations. And you can see here that just as the Fed starts raising rates, consumers who are very much in tune with what's going on in the economy, just at a baseline ground level, because of course they face an economy, they face a price structure every single day, they begin to expect less inflation. And the 1-year inflation outlook, with some bumps in the road, of course, starts coming down. You can see at the same time measures of overall sentiment in the blue, current conditions in the dark gray there, and the forward outlook in the months ahead, they all start to trend higher. And we can see consumer confidence improve. The expectations here are that it will continue to hold up, as the inflation outlook remains relatively low by sort of the series standards here, unchanged from the prior month at 2.9%. So here too, of course, the question is, does this come out better than expected? Because indeed, employment has been hotter. We just saw very hot NFP data. The situation with GDP growth, better. PMIs, better. Job openings, better than expected. And so perhaps the consumer is indeed looking more optimistic. Perhaps this too is going to be another one of these numbers that registers north of forecasts. In which case, again, the Fed might say, we don't need quite as many cuts. Or at least the markets might speculate that they would say that. And so this continues. More cuts fall out of the outlook. Dollar keeps powering higher. Now, whether stocks don't like it or do is an open question. At this point, we've seen them do various versions. As we said here, note, this downtick in the rally here, that's the Fed saying we don't need as many cuts as the markets think, effectively. Here's the CPI data echoing the Fed, arguing with the markets that they've overpriced stimulus. And in both instances, the markets didn't like it. But also in both instances, the trend higher has sustained. So if we get CPI data like this and a Fed announcement like this, it certainly might be that stocks swoon in the face of retail sales data that's hotter or consumer confidence data that's hotter if it eats into rate cut odds. But whether it will actually short circuit the trend higher, who's to say? Unclear at this point. But for the US dollar, things look very orderly indeed. Fewer cuts, higher dollar. And so if this is the way that this data goes, then we probably get follow through on some of the recent moves that we have seen. And that, of course, is the Aussie dollar, something that I've made no secret of holding short. That seems to be cracking its former range. It's retesting it now, but perhaps looks ready to make a run down here into the 63 figure. That means the euro, which seems to have taken out a very important level of support here, as well as the overall rising trend from late October. After a bit of a correction, it might be ready to extend lower and eventually come in for a test of these lows near the 105 level. It might be the British pound, which has behaved exactly as we discussed just yesterday. We said that there was a risk that UK CPI would miss forecasts and the pound on a retest of its range would reverse lower. Well, that's exactly what's occurred. Today, we're going to be looking at UK GDP data, and unlike the US, in the UK, data has been tending to undershoot forecasts. The expectation is that we're going to get a pickup in GDP, year-on-year rate seen going up from 0.2 to 0.3%, the 3-month average seen shrinking at a slower rate, 0.1% versus 0.2, and the monthly GDP indicator seen holding basically steady, although the big number, the quarterly number, seen essentially unchanged, 0.1% decline in the fourth quarter as it was in the third. If that undershoots and the situation is weaker than expected, then you might expect the pound to crack through this support near 125 and see if it can test under 124. But this is not a narrative without concerns. Because indeed, the U.S. consumer may not be handling the pickup quite as robustly. The latest set of ISM data suggests prices are rising in both services and manufacturing. In fact, for manufacturing, it's one of the rare times in recent history that the price is even growing. Of course, in the logic of PMIs, above 50 is growth, and we're there on manufacturing, we're there on services and rising. The markets have, of course, noticed. These are market-based inflation expectation readings. they're pushing higher again since the beginning of the year, and this data has looked higher. At the same time, delinquencies are up. All consumer loan delinquencies back to the highest since before the pandemic. And credit card delinquencies, the ones that tend to be first in a troubled situation for consumers, 30 days and 90 days, both very much trending higher. So it could be that the consumer is in fact undermined here. In which case, if the data is soft, both on sentiment and on retail sales, we could see a situation where actually disappointments come, and what they do is give us more rate cuts. And if that's the case, then perhaps the vehicle of choice is the yen. We're getting short dollars if things start going in the opposite direction, and long yen starts to be the idea just as we come into this support here. Now, we don't have a reversal signal as yet, but if the data gives us one, this might well be angling into a tradable low. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what happens next. Back on with Chris for Futures Power Hour Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com and opining on the platform formerly known as Twitter at @IliasPVAC. Thanks very much for joining. See you tomorrow.